AI optimism, a big reason why stocks have extended their record highs recently. Let's bring in New York Life's Goodwin for more on these markets. Nice to see you.
So good to be here.
You're cautious on the recovery, even though the trend and the momentum feels like it's going one way.
Yeah, that's absolutely. I agree with that.
Why are you cautious?
So the next 3-4 weeks, I think, are full steam ahead for the equity market in particular. And that's because not only has Q2 economic reality been much better than analysts were expecting at the beginning of quarter, just many of the worst case scenario risks have not materialized and are not likely to materialize over the next few weeks. So earnings are likely to be quite strong. But the backdrop, as well as we think ahead, related to deregulation, related to the sort of supply chain reglobalization that's happening, supporting the AI supply chain in particular, that's supportive of market broadening as well. And we've seen some of that breadth. Even in weaker market days, you haven't seen a big rotation into defensives. And so I think that the market will continue to climb this wall of worry in the near term. What I'm worried about is that those great financial conditions, the tariff risks that I do believe will start to manifest in the economic data over the next couple of quarters, and a key risk for the market with respect to immigration and the labor market, those are still interest rate related dynamics that the market's going to have to grapple with.
Aren't we incrementally knocking the wall of worry down? Like, we were climbing the wall of worry when we were worried about inflation. Don't really have a problem with that. When we were worried about the tariffs being larger than they appear they're going to be. We don't really have a problem with that. We were climbing the wall of worry when we worried that earnings were going to be less robust than they've been. I feel like the wall's going in the other way, not up. I mean, we have more concerns to really worry about. It feels like it's not the case.
I think the wall of worry has been effectively addressed and resolved for now. What we're worried about is more a matter of timing, and isn't that always the case for the market? So I'll take your ideas one by one. Inflation. We are starting to see inflation creep into the economic data in June's data. I expect that to accelerate in Q3 and into Q4 because new ordering, holiday ordering, has only just started to happen. The backlog of inventories that companies had before tariff risks began to materialize, that's starting to be cleared. So that risk is still ahead of us. Importantly, immigration and sort of the tightening of the labor market, especially from the supply side, is a risk I think the market actually isn't in the wall of worry, but is an element that's going to impact the sort of interest rate sensitivity of the market moving into the second half of the year. It's not an overly bearish view on the U.S. economy, and in near term, it's actually quite a bullish view on the market. But as those risks start to materialize in the economic data, I think we'll see a rates response.
Well, you'll see a rate cut response. That's part.
No. So
You don't think the Fed's going to cut rates this year?
I think the Fed might cut rates one time this year. And the reason look, when it comes to the inflation and labor market data that we've had so far this year, I think the Fed might have cut already twice this year. But the policy risks on sort of the path ahead are top of mind, and those are what I expect to materialize over the second half.
But the inflation fears, certainly the most severe ones, haven't really materialized. And Powell himself has suggested that they would have already cut if not for the tariffs. So if you continue to go in that track of deals on trade, tariffs not that big of a problem, not like people expected, why wouldn't they cut?
So here's the three reasons why I think it's difficult for them to cut assertively into the second half of the year, even though I completely agree that the data so far suggests that they would otherwise be. The first is that tariff rates are higher than they used to be, but probably more importantly, I think moderate tariffs are actually more inflationary than really severe tariffs. Because if you have really severe tariffs, then you have demand destruction. It's really difficult for companies to operate their supply chains. That's not what we see here. We see a muddle through scenario where companies are going to be so far passing on higher costs or in some cases taking hits to margin. That just hasn't materialized yet, but I do expect it to. The second reason I think it's really difficult for the Fed to cut is that tightening labor supply means the unemployment rate is going to actually be moving lower into the second half of this year, and I think that's an underappreciated risk. And the third is just financial conditions are so easy. Equity markets have been doing good. Credit spreads are tight. If you want to borrow, you can. There's really nothing pointing from a financial markets perspective that the Fed assertively needs to be cutting rates right now. And so I think that they will stay on hold for as long as possible.
But